Thank you and welcome into this video. I would like to walk you through the highly contested and controversial proposal in the Finance Bill 2026-2027, which was calling for introduction of 5% withholding tax on the custom value of the Mutumba cloth. Though it didn't go through the parliament, it was dropped at the committee stage and it didn't get through the draft of the bill by the parliament. But this is what it meant to the consumer, the importers, and the wholesalers of the Mutumba. What it meant, this withholding tax to the importer, is that when an importer imports Mutumba clothing get to the port, they are subject to various taxes, and one of the taxes is the VAT at 16%, which is already there. But additional to that, the government was suggesting a dim tax or a withholding tax of 5% from the gross or from the custom value of the Mutumba cloth, which is per bale. They were suggesting a 5% withholding tax from that custom value of that Mutumba bale. What that meant is basically when the Mutumba lands into the country, the government was deeming that the profit which is equivalent to that Mutumba bale when it is sold, it will be 5% of the custom value of that Mutumba when it lands into the port, which basically it can be correct based on the valuation which the government usually use to value this Mutumba cloth. But in my own thinking, I don't think it qualified to be called withholding tax. It basically could be called also a presumed withholding tax of 5% on Mutumba cloth. But though it didn't go through the parliament, it doesn't mean it is over, because Treasury was basically pessimistic about this tax, and it might reintroduce it through later amendment by the parliament. But because basically what made the parliament to drop this clause is due to public pressure, and bearing in mind we are going to the close to the election, that's why they had to drop it. But what it meant, this 5% withholding tax on custom value of the Mutumba cloth, plus the VAT and other taxes which are charged from these Mutumba clothes when they are imported, it could be a final tax, this 5%. And the meaning of this 5% being a final tax is that when this 5% of the custom value of Mutumba is deducted, the importer of the Mutumba will not be required by law to file their annual tax return and declare this amount when filing their annual tax return. So it is technically a final tax. You pay it and it is over. So that is what it meant. Though due to the politics which was involved by this, we didn't technically go to understand what it meant. But that is what basically it meant about the 5% withholding of the custom value of the Mutumba cloth. But this could have a feedback on the cost of the Mutumba cloth, because it could lead to increase in the cost of the bale of Mutumba, and that burden could be passed by the importer to the wholesalers of the Mutumba, who could later pass the burden to the retailers, and the retailers could pass the burden to the consumer. So it had feedback and a ripple effect in the market, since the introduction of the 5% withholding tax on the Mutumba cloth. First thing first, it was to increase compliance with the revenue authority, since it is easier to monitor this amount at the point of contact rather than monitoring it when the importer gets the good and sell them and then deduct the necessary expenses and then report the profit to the revenue authority, which is deeming that that profit which is reported from this bale of Mutumba is equivalent to 5% of the custom value of that Mutumba. So it is technically, the KRA is basically trying to monitor this income at the point of contact. Also, the reason why they were doing this is to ease the compliance with the revenue authority for the importers of Mutumba goods, since monitoring the withholding tax is very easy. Since you are monitoring it at the point of contact at the port, the cheating levels decline to close to 0%. Therefore, the burden of the tax which the importers are incurring, they will have to pass it to the consumer of the Mutumba cloth, and that will make the cost of the Mutumba cloth unaffordable to a lot of Kenyans, who would later shift to the locally made cloth as the crosses was trying to do. It was trying to protect the domestic market of the leather cloth and also the clothes which are manufactured internally, to drive people in buying them when the imported good or Mutumba cloth gets more expensive. But I think it is punitive tax which could be introduced by the government, and also at the same time could also ease the compliance to the importers. But all in all, the one who is usually affected is the end consumer, since he's the one who usually bears the cost in case there is amendment in these taxes. So basically, that is what I wanted to shed light on. So it was a 5% withholding tax on custom value of the Mutumba, which was a pre-assumptive tax. So it is an assumed withholding tax. That's why I said it doesn't qualify to be called a withholding tax. In my thinking, it was also supposed to be called a pre-assumptive withholding tax rather than the normal withholding tax. So that is the insight which I wanted to share about this. In case you have any query regarding this tax model and what we are expecting moving forward, you can get me using the comment section or the contact in the description. Thank you for watching and have a nice day ahead.